Welcome to the Real Vision Daily Briefing Live Edition. We are live without Annette. I'm Jack Farley. I have the pleasure of being joined by Jared Dillian of the Daily Dirtnap. Jared, how are you doing?
Pretty good. You know, the market moved 7 basis points today, so I'm sure this is going to be a lively conversation.
Yeah, I know Ash and Tony Greer have all the fun. Yesterday, the NASDAQ had the worst day in like over a month, and today equities barely buzzed. But you know, we'll play the hand that we're dealt with, right?
Yeah, there's some good stuff to talk about.
Yeah, so before we get into the weeds, Jared, I want to ask you, how do you make sense of market sentiment? I know that's something that you follow very closely. How do you make sense about how market participants are feeling about the market?
So I guess you could divide the market into the inflation trade and the deflation trade. And if you went back 6 months ago, the inflation trade was very much out of favor, and now it's very much in favor. And I heard somebody today say that it's a bit consensus, which I can't disagree about that. It is. In fact, the inflation trade is getting pretty hot. If you look at XLE, XLB, which I both own, and commodities, which a lot of them are in backwardation and stuff is limit up, like the inflation trade is very hot right now. My concern is that we're going to have a pretty big correction because we need to work off this overheated sentiment. You know what I mean? So I think a correction in commodities is probably going to be within the next 2 weeks.
That's very interesting, Jared. Tell me about what you think could be a potential catalyst for that correction in commodities.
I can't speculate. I'm not really the catalyst guy. I'm the sentiment guy. I can tell you when sentiment gets stretched, but I can't really tell you what the catalyst is going to be. It could be the Fed. It could be something that Biden does. Who knows? It could just be no catalyst. I mean, we could just walk in one morning and lumber's limit down and corn's limit down, and this continues for a couple of weeks. But we need to restore health to the market. We need to clean out some late longs. So I think that's going to happen in the next couple of weeks. And from my standpoint, I'm looking at inflation on a 10-year time horizon. So it doesn't really change anything I do. I'm not going to exit any of these trades to try to trade around it. But it's important to be psychologically prepared for a drawdown. And if you do get a drawdown, you can take that opportunity to add to some of your positions.
Jared, I want to get into the commodity trade and particularly the inflation trade, but just real quick, looking beyond that world to just, let's say, the S&P 500, I did note in your newsletter, the Daily Dirtnap, today you wrote that I really don't think that sentiment has peaked there. So you think that there is still some room to run in the S&P 500. You just think that it's could be a pullback in commodities, right?
Yeah, and we could have a couple of months of the deflation trade where tech starts to rally again, and bonds, bond yields go down. So I mean, we could get a couple of months of the deflation trade, which during the pandemic we called the work from home trade. That could be back for a couple of months. I don't really look at the S&P 500 on a static basis anymore. Like, I don't really care so much about the direction of the overall market. I care about the factors, right? Because I'm very heavily invested in one or two factors, and that's really all I care about.
And Jared, to people who aren't familiar with your work, explain what those factors are.
Well, the two big things are value and inflation. I buy cheap stocks and I buy stocks that have some kind of gearing to inflation. And that's the portfolio. That's it. I'm very much a top-down guy, not a bottoms-up guy. I'm a top-down guy. I look at things thematically. The way I do this is I develop a theme, and then I say which stocks best represent this theme. And then if I feel like it, I can sort of dig down and say, all right, which ones are cheap and which ones have the most beta and stuff like that. But I really do this thematically, and I'm not trying to pick the best stocks. I'm trying to pick the stocks that fit a certain theme.
That makes sense. Jared, let's talk about the minimum wage. I understand that you have some nuanced views about this, and particularly its relationship with the ongoing fiscal stimulus that people have been getting. Tell me about that.
Okay, so there's been a big push to raise the minimum wage to $15 an hour. It's currently $7.25 an hour. That was passed in 2008. So it's been 13 years. We've had some inflation. If you were to inflation adjust the minimum wage, it would be about $10 an hour today. Okay. So if I were a lawmaker, like if I were a Republican lawmaker, I mean, the amazing thing about this, the politics of this are really stupid because the Republicans will fight to the death on the 725 minimum wage. I'm like, this is easy. Just raise it to $10 and then index it to inflation. And then you never have to have an argument about this ever again. So we want a $15 an hour minimum wage. On average, somebody who is not working and collecting unemployment benefits with the enhanced unemployment benefits is making around $21 an hour. So it's pointless for that person to work for less than $21 an hour. So what we've effectively done on a de facto basis, without actually raising the minimum wage, we have raised the minimum wage to about $21 an hour. And low skilled jobs, 6 to 12 months from now, are going to be paying $25 to $30 an hour, and all of this is going to get passed on to the consumer. I mean, here in Myrtle Beach, the minimum wage for servers is like $2.35 an hour or something like that. We have restaurants here paying $15 an hour for servers. And once you raise wages, they stick. You can't lower them. There's no chance they're going lower ever. So all of this is permanent, and it's going to be passed along to consumers. And when I was at Lehman back in the mid 2000s, and commodities were going up, and we were having these discussions about inflation. And people, the economists would say, well, we can't really have inflation until we have wage inflation. Well, now we have wage inflation, and people have more money to spend, and this is going to take off like a rocket ship.
There we go. Well, I think, Jared, no matter what direction we go in, no matter what topic I throw at you, it all comes back to inflation. So let's focus on a particular aspect of that. That is commodity inflation. We have seen lumber prices rise. They're now at all-time highs. The price for live hogs is at all-time highs. For copper, it's back over $10,000. So even though the consumer price index came in at 2.6 a while back, and that wasn't anything to write home about, we were actually seeing in the real economy tremendous increases in price. What do you make of that rise in commodities? I know it's something that you have your eye on as an investor, and how do you see it going forward?
Well, 70% of commodities are in backwardation, and it's pretty steep backwardation. And that's when you have supply tightness in the spot market. And that's, I expect the backwardation to not disappear, but to diminish over time. One of the things that I'm very fond of saying is that high prices are the cure for high prices. Okay. So let's just talk about lumber, for example. So lumber is $1,500. What's going to happen is that this is going to encourage sawmills to get back into production. It's a powerful economic incentive to produce more lumber because you're making tons of money. And people often focus on the supply side of it, but it's not just the supply side, it's the demand side. When commodities get to very high prices, it also encourages consumers to economize, okay? So if lumber prices go really high, then what people should be doing is consuming less lumber. So I've talked to a lot of people in the last couple of weeks about lumber in particular. And the interesting thing is, I've heard one or two stories about people who have postponed building a house. But for the most part, people are just plowing ahead. They're like, I have to do it. I'm going to build a house, no matter how expensive it gets. And, commodities like lumber are going to continue to a point at which people start to economize and demand goes down. And that's true of any other commodity.
Yeah, I think of lumber as somewhat price insensitive. If you've made a decision with, say, your spouse, you're going to build a house, you've already spotted the price of land, and you've made this huge investment in it, psychologically, are you really going to back away at the last minute just because the price of lumber is at $1,300 instead of $1,100?
Yeah, and some people are postponing it. Some people say, all right, well, we'll wait 6 months or a year or something like that. I don't know if you know this, but I actually bought a piece of land in December, and I'm working with an architect right now on some plans. And I was supposed to break ground on a house about 6 months from now, six to 8 months from now. And I'm looking at this, and I have to run the numbers, or else. Now, the other thing I think about this is a lot of people say, well, I'll postpone this decision and maybe it will come back down. But also, if you postpone the decision, maybe it continues to go up and you're even more screwed. So, just from a personal standpoint, I'm inclined to just build the house, because I don't have perfect knowledge of what lumber is going to do. Maybe it's going to come back down, but what if it goes up? So that's the thought process you go through.
So that's lumber, Jared. Now let's move on to oil, which I know has been in your line of fire for a very long time. Since we started talking, and I think for far earlier, you've been very bullish on oil as well as the oil drillers. One thinks of XLE, the ETF for oil drillers. You mentioned that earlier. Oil is pretty much at a relative high over the past few months. It really has not shown any weakness. Today we had earnings from Exxon, where they actually reported earnings per share instead of a loss per share, and the stock was accordingly up. I want to get your take on that sector, and specifically Nam in the comments asked, with this last report of a rising draw on oil, what's the next sign that you're looking for in terms of a directional confirmation?
I think we've gotten the directional confirmation. I don't remember what day it was, but it was last week. And it was the first day that energy ripped. And I commented that, welcome to the next leg up in energy. So, we went from negative $40 a barrel to $20 a barrel to $60 a barrel. And we had a long period of consolidation. And now we're breaking out, and we're going to go to somewhere between $80 and $100 a barrel. I'm not really plugged into sort of the micro factors that affect oil, but just looking at it from a chart basis, like it's going to go higher. By the way, right before we got on the call, I saw an amazing chart of TAN versus XLE, okay, TAN being the solar ETF, and that peaked the day that Biden was inaugurated. The day that Biden was inaugurated, TAN started going down and XLE started going up. So.
Wow, that is fascinating. I'll have to make a chart of that, put that on Twitter afterwards. I mean, talk about buy the rumor, sell the news, right?
Yeah.
Okay. So that's oil. Just one last thing on the inflation thing. I think that you had some views on Warren Buffett, the legendary billionaire investor and chairman of Berkshire Hathaway. They had a shareholder meeting, and he made some comments about inflation that you and I both found interesting. What do you make of them?
Yeah, I mean, basically said, within their businesses, they're seeing a lot of input cost increases. They're seeing a lot of inflation. Berkshire, which is, at all-time highs, is, they're perfectly positioned to benefit from this. I mean, it's mostly insurance, and insurance benefits from higher interest rates and a steeper yield curve. And they bought the Japanese commodity trading firms, which is a bet on value and it's a bet on commodities. So, my guess is, they have 146 billion in cash. You're going to see some acquisitions in the next 6 months at a Berkshire that are going to be very much inflation-related acquisitions. And Buffett is, he's usually not the first to act on this type of stuff. He's usually second or third. But there's still he thinks very long term. And if there's 10 years left in this trade, he's gonna do one of these acquisitions.
Absolutely. Berkshire has a tremendous amount of cash on its balance sheet, and you make a very good point. The few acquisitions that he has made over the past 2 years or so were energy related. One thinks of Dominion Energy. Let's move on to earnings season, Jared. You had very positive earnings, something around 90% of companies beating their expectations. And equities, continued to grind higher, but we didn't see that zealotry from the equity market that we are, perhaps have been used to over the past few months. What did you make of the sentiment around earnings?
Yeah, I mean, that's another example of buy the rumor, sell the news. For the last year, everyone said that, when we get out of the pandemic, that economic activity is going to pick up. It's being reflected in corporate earnings. I don't remember the percentage that beat earnings, but I do know that the stock reaction the next day was an average of 16 basis points. So it's a little concerning because this is like a classic sentiment signal. If something doesn't go up on good news, it's usually a bad sign. I don't really know how to interpret that. Like I said, I'm not paying much attention to stocks these days, but from a sentiment standpoint, that doesn't seem very good.
Jared, you said you're not paying much attention to stocks these days. What do you have your eye on other than commodities?
Rates usually. Still paying attention to rates. I don't. I think there's a possibility that rates could go lower in the short term. I think we could get 10s to 1.4%, but I still think that the pain trade is higher in rates. I do think we get higher in rates over the next 6 to 12 months. So I don't think there's much chance we get rates back to 1%.
So would you be a seller of out of the money put options on let's say something like TLT or Treasury ETFs?
I don't really. That's actually kind of an interesting trade. But no, I wouldn't be doing that. I have no desire to play this at all. I really don't.
Yeah.
So
understood. Excuse me. I actually meant to say a seller of calls on the.
Yeah, I knew what you meant.
Yeah. There we go. Let's see. Ollie Slater from the United Kingdom asks, if we were an enduring inflationary environment, if we were in an enduring inflation environment, and you had to buy and hold two assets for 10 years to protect you from inflations, which two would you choose?
Well, gold would be one of them. And probably the ETF INFL, which I hold.
Mm-hmm. So, and tell the audience a little bit about INFL.
INFL is an actively managed ETF. It's run by Horizon Kinetics. It's a new ETF. It's been out for about 4 months, and it's called the Inflation Beneficiaries ETF. And they invest in companies that theoretically benefit from inflation. So they invest in capital light businesses. Okay, so commodity businesses that don't have a lot of capex. In a lot of cases, that means royalty companies or streamers. So they have like 35% royalty companies. Interestingly enough, they also have exchanges. They have about 20% of the portfolio are futures exchanges, which benefit from volatility, which will increase as inflation increases. So it's a really cool portfolio, and I actually bought quite a bit of that, and I think it's good for the long term.
Very interesting. Jared, so I know you said you don't follow the equity market that much. You must have noticed the big sell-off yesterday that Tony and Ash got so lucky to host the daily briefing on. I know earlier in the year, when you started to see some weakness in the high-flying tech stocks, you really put your foot down on the pedal, and you actually shorted some of those stocks, and some of them were successes, which is very hard when you short stocks. One thinks of Tesla. Right now, we're seeing that weakness again, or at least we did yesterday. How are you thinking about the value to growth ratio, and are you thinking about even maybe shorting some of these ultra growth stocks?
I'm not. If you look at a lot of the mega cap tech stocks, the valuations are pretty reasonable. Google is like 19 times earnings, and after that last earnings report, it might even be lower. Facebook is not egregiously expensive. Apple certainly is a little bit overpriced, but these are not like outrageously expensive stocks. Now, back about 4 or 5 months ago, when tech stocks peaked, I got some feedback from subscribers. They said, I'm going to short tech. I'm going to short tech. And it seemed like a very obvious trade. But tech basically went sideways for the next 4 or 5 months. And if you were buying puts, it was very painful. So, as I've said before on the daily briefing, I don't really like to play the short side of stuff. I like to play the long side, which takes us back to value. And, I think that's the place to be.
Okay, so let's focus on those areas. We've already talked about energy. There's also commercial real estate. There's uranium, which is a somewhat uncorrelated sector. So tell me about those, and what else is on your mind in terms of the longs that you think will be able to ride the tailwind, the inflationary tailwind that you see?
Really, you could just take the top 50 names in IJS, the small cap value ETF, and throw spaghetti against the wall, and I think you'd be pretty happy.
Okay. Jared, could you break down for the audience, what is it about value now that you like so much?
Well, if you go back to the pandemic, value really got trashed. It was the work from home stocks that benefited, and the stocks that got hurt were the stocks that were generally value stocks. That changed. I don't remember the date, but it was the day that the Pfizer vaccine was announced, and value outperformed by 15 standard deviations. And value's been in an uptrend ever since. I mean, small cap value was up like 50 to 60%. And there's some people that focus on growth and value a lot, and you might see them on Twitter, but a lot of people really don't. And that's been the story of this market, is that value has been very stealthily outperforming growth. And it reminds me a lot of 2001, 2002. When we had that period of value outperformance, it's very similar. So, I mean, this is going to, anytime you have a style box trade, these things continue for a really, really long time. So I don't think the answer is to short tech. I mean, there's probably some active traders that are listening to this that are looking for opportunities to short Google and stuff like that. I just think it's kind of a waste of time. I think there's a lot less stressful ways to play this.
Absolutely. And one could say, based on your previous point, that Google isn't necessarily a growth stock. Yes, of course, it grows. It is a secular grower. It can grow in all environments, but its price to earnings multiple isn't crazy. I think that when we really think about growth to value, one thinks of like a company like Snowflake, which had a price to sales ratio of 100 when it IPO'd. So yeah, I think that the more speculative part of the market, right, is growth.
Let me just jump in about Google for a second.
Yeah.
Google is a very interesting case because they should pay a dividend. They should absolutely pay a dividend. This is a cash generating company. I mean, their ads business is a very stable business. They can easily pay a dividend. And if you go back 6 or 7 years ago, they had all their moonshots, Google Ventures and Google X and stuff like that. They still have the self-driving cars, but a lot of these moonshots didn't pan out. So it's growing rapidly, but it's not really a growth company. It's really more a value company. It trades at 19 times, and they should pay a dividend. And the only reason they don't is because some activist can't come in and force them to pay a dividend because they have the two share classes. So they maintain control over the company. But if they didn't have that, somebody would have come in and agitated for a dividend by now.
That is really interesting. Jared, someone else asked a question asking, Jared, I know that you're watching gold, but any thoughts on silver or SILJ?
Yes, the Junior Silver Miners ETF. That's a great ETF, by the way. That's a great ETF. I haven't looked at SILJ in a while. I'm bullish on gold and silver equally. Let's put it that way. And I have both, but I have a much bigger position in gold. So I don't think it. If I think you should have both. Probably 75% gold, 25% silver. But I don't really have an opinion as to which one's the fastest horse.
Interesting. Someone else asked, what are some alternatives to the ETF XME?
That's an interesting question because XME is a tough ETF to own because it's so volatile. It's exceptionally volatile. It moves around like 4, 5, 6% a day. I don't have a good answer for that. I've owned XME at some points in the past, and the volatility just sucks. I hate it. So nothing really springs to mind off the top of my head that's an alternative to that.
Jared, now this is a question from me. Let's zoom in on the bond world. I believe that most of your views on bonds, you expect yields to continue to rise in the long term. You like to express those views in the equity markets with something like commercial real estate or INFL or energy. But just tell me your view on bonds in light of the perhaps Freudian slip from Treasury Secretary Janet Yellen yesterday.
Yeah, I thought that was kind of interesting. I mean, I understood where Yellen was coming from. Like, she said something just in the abstract. I mean, it's just very obvious. Yes, of course, we will have to hike rates someday, whether it's 5 years from now, 10 years from now, 2 years from now. So in the abstract, we have to hike rates. And that's what she meant by that comment. I think it's kind of a Freudian slip. I mean, I don't think the Fed is talking about raising rates. I think they're talking about raising rates, if you know what I mean. You've got Dallas Fed President Robert Kaplan, who's getting louder and louder about raising rates in 2022. So he's not a voter. He's not a member of the FOMC, and he won't be until 2023. But it's starting to build a little bit. But nonetheless, I think the Fed, I think I came on here before and said that the Fed would probably hike in 2022. I really don't think that's going to happen unless inflation just gets egregiously bad. It's probably a 2023 event.
Okay, so it's a 2023 event on the short end, but in the meantime, you expect long-term bonds could get sold off, meaning their yields could rise, meaning that the yield curve could get a hell of a lot steeper than it is now. Do I have you right?
I don't know about a hell of a lot. I mean, it could get 50 basis points steeper, and that's material. And that would be great for insurance and banks and a lot of businesses. But I don't think we're going to go back to the days where we have 300 basis points, 2s, 10s. The curve's not going to get that steep.
Okay, so you're not fully part of the bond vigilante party.
Well, I'm a bond vigilante, but I'm just kind of realistic.
Yeah. By the way, I said the word party to really myself up to my segue, which is, Jared, it's my understanding that you, publisher of the daily Dirtnap, are having a party sometime soon for all members of the daily Dirtnap. Tell us a little bit about that party.
Yeah, so it's going to be June 25th at Do Supper Club, DOUX Supper Club. It's at 21st and 6th in Manhattan. Everybody is invited. It's not just for the Daily Dirtnap. So if you're listening to this, just stand by, because I'm going to be sending out links on Twitter for tickets and stuff like that. It's from 8 p.m. to 1 a.m. I'm DJing it. My friend Adam Silver's DJing it. And it's actually, I think it's going to be a raging party, because it's going to be the first one in a really long time, and people are looking to get out.
Yeah, it absolutely sounds like a raging party. Jared, I was actually thinking of hosting a party, and I was going to name my party Welcome to the Roaring 20s, but I think your party is so on brand for you. If you wanted that title of Welcome to the Roaring 20s, you could have it.
Now, mine's going to be Welcome to the Terror Dome.
Oh, there we go. Well, Jared, I definitely will be there, and I hope that some of the people watching can join us as well. Jared, I will say this. If I had a choice between going to a party run by inflationists versus run by deflationists,
yes,
easy choice for me.
Yes, absolutely. Yeah. The deflationists are a glum lot.
Yeah, they probably just read economic theory and talk about buying bonds and Eurodollars. Okay. Jared, as we reach to a close, there has been a slew of economic data that we've seen today. The jobs number today missed the mark slightly, but it did revise some of last month's numbers, so it wasn't a total miss. But then I also know there were some PMIs today that were very positive, as well as a blowout prices paid index that came out on Monday. So tell us how you've been, sort of evaluating this economic data that we've been seeing.
Yeah, I'm not too focused on the jobs numbers. I do think that hiring is going to slow down a little bit. We're not going to be getting, 1 million jobs prints. We'll be getting 800,000, 700,000, stuff like that. I don't really know how the market's going to interpret that. And that's just a function of the fact that it's going to be very difficult to get people back to work. The prices paid on services ISM was at an all-time high. And I got to tell you, this is the sort of thing that, back in 2004, if you saw these types of numbers on an ISM, you would be doing intermeeting 50 basis point rate hikes. I mean, this data is hot. It's really, really hot. And the Fed is totally negligent on this, which everybody knows, so we don't need to get into that.
Jared, how do you think that this phenomenon will evolve, where if we continue to get this beyond rosy economic data and the Fed, what will happen? What will have to happen for the Fed to say that they changed their mind? I mean, do you think that we could see an ISM of 85 in September and the Fed not even make any noises about raising rates at all? I mean, where do you see this going forward? I mean, it's such a dichotomy.
Yeah, I think there's going to have to be a lot of, I really don't think it's the data, right? Because CPI, the way it's calculated, it's very difficult for CPI to rise significantly. Let me put it this way. If we had 4% CPI, we would be feeling it. We would definitely be feeling it. There would be a lot of misery out there, 5%, 6%. So I think really what it's going to have to get to is we're going to have to build a narrative that inflation is building and it's a problem, and that needs to work its way up to the government and the Fed, where people are complaining about it enough so that we're going to do something about it. I think we're a long way away from that happening. You know, anytime you get inflation, the first year or two, when inflation is still pretty low, it feels great. And right now, this feels great. The economy's hot. It's a party. Everybody's making money. It's terrific. But once you get to like 2023, 2024, and we're still dealing with this inflation, you know, people are going to get sick of it pretty fast.
Jared, paint me a picture of what you see, because it's my understanding you're quite an inflationista. You think it's going to be high and you think it's going to be persistent. And yet earlier in the show, you said that, oh, the 30-year, it could sell off 50 basis points. So that's a pretty wide gap. If inflation continues to be hot, and we see it in the CPI, and bonds say somewhat range bound, I mean, how negative do you think real yields could go?
They could go pretty negative. I mean, the bond market, I'll see a lot of people when they look at interest rates, they bring in all this stuff that doesn't matter. They say, well, productivity is high, therefore interest rates are going down. Productivity doesn't have anything to do with interest rates. The only thing that determines interest rates is the supply and demand for government bonds, how government bonds are traded. That's it. So we're going to be having a lot of supply because we're running bigger and bigger deficits. The next quarterly refunding is going to be huge. We're seeing the bid to cover on these auctions get worse and worse. So it's difficult to absorb that supply. And on the demand side, like, who the hell wants to own treasury bonds these days? I mean, you know, foreign ownership of treasuries has gone from 43% about 10 years ago to 29% today. So just looking at the supply and demand dynamics, I don't care about productivity. I don't care about anything else. It's all supply and demand for government bonds.
So, Jared, the reason that governments have to issue so many government bonds, the reason there is such a supply, is ultimately because of fiscal spending. We have what, $3 trillion of fiscal spending, on the horizon. What have you made either the actions or just the noises that have been coming out of the Biden administration about their plans for unprecedented fiscal stimulus?
Well, I think this is going to continue until the 2022 midterms. You know, I think the Biden administration is looking back in history, you know, at Obama in 2010 and Clinton in 1994, where they got 2 years of spending in, and then the Republicans took Congress, and then you had 6 years of austerity. So I think they're looking at that as a blueprint, and they're trying to get as much spending in as possible before the midterms.
That makes sense. Jared, one of my final questions for you is about uranium. It is traditionally thought of as an uncorrelated asset. It's not correlated with rates. It's not necessarily correlated with the equity market. Tell me about some of the secular tailwinds that make you bullish on uranium, and what have you seen out of this market as it's performed extremely well over the past half year?
You ready for my answer?
Hell yeah.
It's going up.
There we go. Please, Jared. please elaborate. It's never good when the answer is better than your question. It shows I'm not doing a good job. So please, you got to go on.
Yeah, I mean, the thesis hasn't changed. You know, I've owned uranium stocks for probably about 18 months now, and I accumulated these positions, you know, when Trump was president, you know, because the climate issue was building. And I said, any rational person who looks at this problem and thinks that we're going to get out of this with wind and solar is just insane. I mean, you need nuclear power. So it was a bet that at some point people were going to get smart about this, and I think that people are going to get smart about this, and we're going to have more nuclear power in the future.
There we go. Jared, thank you so much for joining this edition of the Real Vision Daily Briefing. Oh, wait, sorry. We got one more question. Will gold stay range bound too? From Prius Omega.
Well, what's the question?
Sorry, will gold stay range bound as well?
There's some resistance at 1850. There's some trend line resistance at 1850. If it gets through 1850, then we're going to run up to 2050. But I think this consolidation is probably going to last another month or two.
Okay, great. Final question for you, Jared, from Tom, who's got quite an imagination. He asks, Jared, would you rather own a 10-year U.S. Treasury bond or Dogecoin?
I'd own the Treasury bond.
That's what I thought you'd say.
Yeah.
There we go. All right. Well, Jared, thank you so much for joining us. It's been an absolute pleasure.
All right. Thank you.
Thanks. All right. Thanks, everyone, for watching.